buying and selling a stock is not the only way to make money in the stock market. And in this investment video, we'll talk about 4 ways how owning a stock makes you money. If you're new here, my name is Ron and welcome to Pinoy Stock Investor. But before we start, let me know down in the comments, what company have you held the longest and why did you decide to sell it? Was it performance issue, fear, or a better opportunity? It'll be really interesting to know. Okay, starting with the market check. Let's go look at how the market is currently doing it right now. So today, S&P 500 is up by 0.18%. Dow Jones is up by 0.11%. QQQ is up by 0.23%. And it looks like the market is definitely up for today. And how does our portfolio looking right now? Okay. Right now, our full portfolio looks like it's up by 0.51%. And looking at the taxable account, which is, I call it our main portfolio, it is up by 0.70%. Oh, decent enough. It's a bit higher than last week. So I guess this is a better bounce back for the portfolio. Okay, today we are going to invest $100 and let's plug that into our Google Sheet. Okay, it looks like we're going to invest $16 for industrials, $7 for financial services, and communication services we're going to invest $25, and for technology we're going to invest $12.66. All right, let's go start. Okay, starting with our industrials, which is Uber, we are going to invest $10. I know it says here we're going to invest $16, but I just feel like investing $10 right now. Okay, so we're going to invest $10, and that is 0.141 shares. Okay, next we're going to invest in our financials. That is Visa and MasterCard. I think I'm going to skip investing in Visa right now because I have a different plans for it. So yeah, we're going to move forward to our MasterCard holdings. We're going to invest $10 to MasterCard. All right, that's $10. $10 is 0.019 shares of MasterCard. Okay, next is communication services. Under communication services, we have Google. And right now, Google is down by 1.32%. Let's buy $25 of Google. All right, and that is 0.082 shares of Google. All right, so Google is one of the best performing companies last 2025 in my portfolio. And one of the things that they did is they bought back a lot of shares. They did this share buyback program back in 2025, and it is $70 billion of buyback. And one way that stocks and companies return value to the investors is by means of buyback, or they call it re-slicing the pie, or at least I call it re-slicing the pie. Share buybacks is when a company like Google or Apple buy back their own shares. They technically retire those shares. So those shares are not going to exist anymore once they bought it back. That means that the share that you're currently holding as an investor increase its value So it's like if there is 1,000 slices of pizza and you own 10 slices of it, it is 1% of the company. Okay? And then if the company bought back 100 slices of pizza and from other people, not your 100 slices, it makes it that your 100 slices is part of the total 900 now because they bought back 100 slices. So your percentage of ownership or the amount that you own in that business generally increase. So instead of 1% from 10 slices of 1,000 slices, you now own 10 slices of 900 slices, which is 1.11% without you doing anything but just holding that share. So you can see that benefit from there wherein you didn't do anything, but once after the company bought back shares by their share buyback program, it increases the value of your ownership. Okay, so one example is that one of the company that I'm holding that regularly do buyback is Apple. So Apple had 110 billion buyback program back in 2024, and then back in 2025 they have a 100 billion buyback program. And with this amount of buyback program that they're doing, they're essentially giving a lot of value to their investors. So it makes it that my Apple holdings increases in value without doing anything. That's the most, I think that's one of the most important thing that we should look at in there. I didn't do anything, so there's no taxable event that for me that I will incur. Because if you sell your stocks, you get taxed from selling your stocks. So by doing buybacks, these companies gives you or push the value of what you own, or push the value of your ownership without a taxable event on your part. Okay, moving on to our next company that we're gonna invest. Right now on our list, it is Apple. We're on our technology stocks now, and on our list we have Apple. Okay. So it says here that we're going to invest $12 for each company, $12.6 for each company. So in Apple, we're going to invest $12. No need to put the 66 cents in there. So I'm buying $12 of Apple, and that is 0.045 shares of Apple. Okay. Next is Berkshire Hathaway. I know Berkshire Hathaway is not a technology company, but whenever I'm buying stock, I buy it after Apple, just because that's how I want it. That's how my format is. But also, I treat Berkshire Hathaway as an ETF on my portfolio, since it's holding a lot of companies, and by owning a share of Berkshire Hathaway, you technically own those kinds of those companies that they are holding to. Part of it. Okay. So for Berkshire, we are going to buy $10. Well, Berkshire Hathaway. Okay. So $10 of Berkshire Hathaway is 0.019 shares. Now, the way these companies provide return to you as an investor is when they use their free cash flow to invest back into the business. When these companies buy new properties, new equipment, new tools, it's a way of them putting back value to the business. So increasing the value of the business. New factories, they design new products. For Apple, they design new iPhones. They acquire other companies. That is one way they're trying to grow the business. And by using this cash to buy equipment or buildings, the company is increasing its what we call book value. So it's the total value of what the company is like physically owned. That whatever equipment, whatever tools, whatever anything physical that they own, and as a shareholder, you own part of those assets. And reinvestment can lead to higher future revenues. So, if you're a farmer, you have one tractor that's doing the farming for you, or that's helping you work on the farm right now. If you buy another tractor, you're going to be able to produce more products. That's just a simple way to say it like that. So if you have one factory here and you build another factory, you're going to be able to produce more products. Like for example, when it comes to Apple, they're now building new factories to another countries, and that makes them, and then that makes it that they reinvest back into the company, and they're able to make more products that they could sell. And reinvestment can lead to higher future revenues and more efficient operations, like that simple example with the farmer, and which essentially builds a bigger company. And remember that you own shares, or you are a part owner of that company. So the bigger they get, the more benefit you get, the more benefit you earn. Okay, let's go back to investing. We're going to invest on our two remaining companies, which is Microsoft and Amazon. Right now, we're going to go invest in Microsoft. So we still have like $34 on our investment budget. For Microsoft, we're going to invest on $17.06. And $17.06 is 0.042 shares of Microsoft. Okay. Next is Amazon. Let's go buy that share of Amazon. Let's use the remaining value of our remaining investment budget for today, which is 17.44. We're going to invest 17.44 to Amazon, and that is a total of 0.086 shares of Amazon. Okay. Now, these companies, they have debts to pay. Okay, that's just part of the business, owning debts. And when the company, just like a person paying off their mortgage or a person paying off their car, a company can use its cash flow to pay off or pay down their debt. And every dollar of debt that paid is a move for having a stronger foundation of the business. So every dollar of debt paid is a dollar that you generally earn as an investor. So a company with less debt has less risk, and it's safer and more financially flexible. So paying their debts is making your shares more valuable. And these companies, when they pay down their debt, it increases the value of the whole company. So your shares will also increase its value, your ownership will also increase its value, and that's another way that companies return value to you as an investor just by owning it. Okay? And one of the most popular that how companies return value to their shareholders is through dividends. And yes, I know everybody talked about dividends, but I just want to add it to this. Dividends is like a rent from your stocks. So imagine that your stock is the stock that you own is like a property, and the dividends that they paid, if they are paying a dividend paying company, the dividends that they paid every quarter or every bi-monthly or monthly, some companies pay monthly, some companies they pay every quarter, but most of them are pay every quarter. You treat them as rent, or I treat them as rent. And imagine owning a US stock like a tiny piece of shopping mall. And in this shopping mall, there's this companies like Starbucks, like all those tenants that pays rents to the shopping mall. And then as an owner, you are entitled to that rent that got paid to the shopping mall. And then if they, after all the expenses, after all the operations, after all the bills are paid, and they don't have anything or any use for the rest of the cash, and they have a huge cash pile or a part of it, they can give it to the investors as a dividend, and that dividend is like a rent to you. And that's one of the benefits of being an owner of a stock or owner of a property or owner of an asset. You get to have those returns and you get to enjoy them. So those dividends are like a payout, or are like a rent to you as an owner. That's like one way of having a true passive income. Not that it's passive because you work to invest your money on that company, but that's the closest that you could get to having a passive income, waiting for or being paid dividends every month or every quarter. So blue chip companies like Coca-Cola, Pepsi, they've been paying their dividends without a miss for 50 years. Every quarter, they never miss their payments. As an owner, back then I used to own Coca-Cola and Pepsi, and those dividends are really great. And it felt like you own property, a real estate property. You get these rents on a regular basis. And like what I said, these companies are blue chip companies, which they've been continuously paying those dividends for over 50 years. And that is one great feat, because not everybody can do that. Not every company can do that. So owning a stock is equivalent to owning a productive asset or a business. And as the business grows, you as an owner benefit from the wins that the company is generating. So when they start buying back their shares, it generally increases the value of your ownership of that company. When they reinvest back into the company, those new equipments, those new tools, those new vehicles, those new properties, the future revenues that they're going to produce, you are going to benefit from those revenues. And when they pay their debt, when they make sure that their foundation is solid, it increases the safety of your investment as an owner. The risk decrease when companies pays their debt, and it makes your company more valuable, which increases the value of your ownership. And the dividends, they are really great part of investing. They're one closer way to a true passive income, and that is one way you can get another source of income from just owning the business. If you get value in this video, don't forget to like and subscribe this video. It's free and it will definitely help my channel. Let me know down in the comments, what kind of investing style do you prefer? Do you like that buy and sell style, or do you like owning the asset for a long time? Let me know down in the comments. And see you in the next one. Have a great day and peace.